Today's guest is Jeff deGraaf. Jeff is founder, chairman, CEO, and head of technical research at Renaissance Macro Research, or RenMac. He launched the firm in 2011. Jeff is a member of Institutional Investors Analyst Hall of Fame and has been ranked the number one technical analyst on Wall Street for over a decade. Jeff, thank you for spending some time with us today.
Alex, thanks for having us.
Let's jump into your background. Let's go back a few years. What originally sparked your interest in investing?
Oh, investing. I think it was probably the numbers and just the ever-changing nature of the business. Of course, I didn't know that at 12, right? But I figured that out pretty quickly at about 17, 18. And it just, it felt like something that was always fresh and new, or at least had the opportunity to be fresh and new. And so instead of engineering or psychology or some of these other pursuits that I always was interested in, I thought this was kind of something that hit on each one of those, right? Numbers heavy, a behavioral element that's important, and investing seemed to fit that bill for me.
It's interesting when you look forward from that point, decades later, it seems like all those things that you thought about earlier on are probably even more true than you realized at the time.
Well, certainly. And, the progress that we've seen in technology makes it even more so, right? So it's pretty fun to have a database and, really, we kind of were doing AI before AI was a thing, right? We have to code it and come up with those nuances and ideas. But with our database and going through and looking at different scenarios, that's always been a really fun part of the business. And I think something that gets lost in this business a lot is just the importance of creativity. Anybody can plug numbers into a Gordon growth model and get an answer, and that answer is going to be very precise. But really, the genius of the Gordon growth model is not the math itself, but it's those inputs, right? And those inputs require an enormous amount of creativity, an enormous amount of self-reflection, an enormous amount of due diligence. And so I think that creativity part of the business is one of the more fun and frankly overlooked aspects of the business as well.
So you spent some time at big organizations like Merrill, Lehman Brothers, ISI Group. What were your key learnings from that experience?
Well, Merrill was where I really first cut my teeth and found technical analysis. So I came from the fundamental side. I was always, classically trained, if you will, from the fundamental discipline. And I just kept finding failures, not only in my own, personal experience and the challenges there, but when I looked around the organization, or Wall Street for that matter, and just the persistent failures that we saw from fundamental analysts and the mistakes that were being made. And my mentor, Steve Shobin, was at Merrill Lynch at the time, and he ran a midday call where he'd talk about the charts and talk about some of the things that he was seeing. And it just, after a period of time, I just kept recognizing that he was getting it so much more right than the fundamental analysts were. And that's not a fault of the fundamental analysts. I'm not talking about any specific fundamental analysts. I'm just saying collectively as an organization, he would recognize things that the market was sniffing out that the consensus just wasn't able to see. They had blinders on. So part of that behavioral side of the ledger. And as I started looking more and more into it and understanding what this thing called technical analysis was, it really resonated with me because it was very much probabilistic in its thinking. It was very much about using data, about really taking the biases that everyone, I don't care who you are, everyone brings to the table, and checking that at the door. If you're good, if you're not good, you're going to let those biases seep in. But and that really resonated to me or with me, and so I really started to pursue it. And the more I pursued it, the more it became interesting. The better I got at it, and then obviously drove my career from there. Merrill was obviously catering more in the days back in the 90s to the retail investor. Nothing wrong with that by any means. Lehman Brothers, when I went over, I actually joined Steve and went over to Lehman Brothers and worked there for 9 years. At the time, Lehman was much more of an institutional shop, right? So we were dealing more with portfolio managers and pension funds and the like. So it was a little bit of a transition from more of a retail-oriented crowd servicing that to something that was more institutionally based. And then, in 2007, I just had bulge bracket fatigue. I was, 17-ish years in the business and all at major wirehouses. And at the time, I joined ISI, which was a small research boutique. I think I was employee number 100 or 107 or something like that. So it was a small firm, but really we outkicked our coverage, if you will, had some really high quality analysts and focused on the macro. And 4 years into that, the firm expanded and started doing some other things that kind of replicating the bulge bracket experience, which I had obviously left. And so I said, well, we'll start our own firm and just focus on the core, which is, essentially macro and then stock specifics around the quantitative side of the ledger, not the pure fundamental side.
You mentioned the distinction between technical and fundamental analysis. It seems like most investors are fundamental analysts, and you're obviously an expert in technical analysis. Would you describe the difference, or our audience is fully aware?
The fundamental side is looking at the balance sheets, looking at the income statements, looking at the big picture economy, basically the data and fundamental analysis particularly tends to be more micro than macro, but looking at earnings estimates and those types of data points to then glean what the expectations are for the company. And again, getting back to that Gordon growth model, right? Determining what the growth is versus the K and where the hockey stick is, if you will, where growth, goes from maybe being geometric to something that's more steady state and more of a perpetuity, which is always challenging. So that's the kind of the foundation for fundamental analysis. Technical analysis is more, if I had to simplify it, I'd say fundamental analysis is more talking, and technical analysis is more listening. Right? We're kind of taking the assumption that the markets are ever knowledgeable, that the price is reflective of that collection of all those hardworking men and women that are doing the fundamental analysis and coming up with some type of projected price that's always changing on a daily basis. That's changing. The estimates are always changing. And so the technical side of it is saying, look, we're going to listen to the market. What's the market saying? Are these trends in place? Is there some type of mean reversion that's likely to happen here based on price and historical pricing, and then using that to your advantage within the marketplace? And by all means, there's a holy war that goes on between technical and fundamental. I think it's silly, to be honest with you. I think they can work in unison. But from our standpoint, we found that listening to the market tended to be a stronger proposition than trying to tell the market what to do, which is how we would characterize fundamental analysis.
And I suppose that goes back to your earlier years where you saw both, and it seemed that technical had a higher probability of, in a sense, predicting what's going to happen next than fundamental. Is that accurate?
I would say that it was equally as good without a lot of the brain damage, and it didn't make the big mistakes. Now, you can make big mistakes. There's no doubt about it. But I think when just like a fundamental investors are kind of growth oriented or they're value oriented, right? You kind of fall into one of those two camps. Maybe you can be GARPy, growth at a reasonable price, but generally you're either a growth investor or you're a value investor. Technical analysis is not that much different. There are either trend followers or there are mean reverters. In other words, trend followers are I'm up, so I'm going to be up tomorrow or be up next month or whatever the case may be. So kind of we would call it autocorrelation in statistics. Mean reverters believe that because you're up, you have to go down. And, you can play one of those two camps. Both of them have their strengths and weaknesses. We tend to be trend followers because we find that over a meaningful period of time, that is a much better state to be in than a mean reverter, though we do employ some of those techniques as well. But it really, as you start drilling down, you can start to see similarities in the approach to both of them, right? A growth investor would be more of a trend follower. They believe that things are going to get better and things are going to be stronger, whereas a value investor believes in mean reversion, that things are very cheap and they're going to start to normalize as you go. So they're not completely mutually exclusive. I think they're closer. Maybe their approach is different, but I think they're closer in terms of their kind of core philosophies than people give them credit for.
So would you explain your analytical framework at a high conceptual level?
How long is this podcast? It's only like an hour, right? Yeah, look, I mean, from a macro standpoint, and we do a lot of macro work, and I think it's important work for just laying out the foundational structure of the market at any given point in time. So we look at trends, we look at the path of least resistance, if you will. There are several different ways that we can do that. We do it quantitatively with a combination of different things. Again, all price based. We don't look at forward GDP. I don't. Neil does in our shop, but we in our discipline just look at price, volume, and some statistical techniques around that. Then we look at the backdrops around different indications that we've found, right? We have this thing that we call the market cycle clock, which gives us this juxtaposition against these inflation and growth measures that we've deemed to be really very important structurally or foundationally for the market. That data goes back to the late 1940s. So we look at where we are within the context of our market cycle clock. We look at where the trends are. We look at sentiment. We look at how people are positioned. Are they overly enthusiastic or overly pessimistic? We look at leadership characteristics. So we can look at various elements like cyclicality. Are people more or is cyclicality, cyclical names, are they outperforming defensive names? And then we look at credit. Credit's a big part of how we think about the world. Is the availability of credit reasonable for the market expectations? Is the price of credit reasonable or is it elevated? All those things play into that stew that we look at that then kind of kicks out our expectations for equities and bonds and gold and silver and oil for that matter.
And in general, are those expectations over longer timeframes or shorter timeframes?
No, I would say, I mean, I don't, that's always, everybody's got their unique circumstance. We're always, shooting between the 3 and 12-month mark. I think that's a reasonable expectation. I mean, if you start looking at data, right, then, and you have high frequency data, right, let's say you have a monthly data point, and your monthly data points are saying, hey, the next 6 months should be good or 6 to 12 months should be good. Well, what happens in 3 months when that data point might look worse, right? Is you still have that 6 to 12 month outlook that's in the future, right? Should that still be part of that, right? So there's a lot of nuance when you get into data. Everybody loves to think that data is very specific and it's all very scientific, but there are a lot of things that you need to do that are frankly judgment calls that you just can't get away from, that you have to be very rigorous around and methodical around. And certainly we take the time to do that. But I would say our kind of meat of the expectations is 3 to 12 months. Obviously, if you start going any longer than 12 months, you start getting into just pure guesswork and, the data, whether it's really that accurate out 12 months, extended beyond 12 months becomes kind of questionable.
And so you talked about mean reversion versus trend following as kind of two different disciplines within technical analysis. Is your sense that 3 to 12 month window trend following may be more effective?
Without question. I can prove it to you time and time again with the data. So anything that's basically a month or less tends to be mean reverting. It goes out to maybe as far as 3 months. Anything over 3 months, again, that kind of becomes edgy. But once you get into the 6 to 12 month camp, it becomes trend following. And I think that's important. In fact, one of the things, and you see this a lot, there's criticism out there that people say, well, every time you put something out for the S&P out 6 months, it's always positive. Like it's never negative. I'm like, well, that's a reflection of, 65% of the time, the market's going to be up. If you go back over 60 years, it's going to be up in that 6 month time frame. And that tells you kind of how aggressive you have to be a bear in any random 6 month period, right? So, yeah, absolutely. That autocorrelation really, really shows itself as you start to extend that duration. And, by all means, I would hope that most of the investors here are not thinking about major decisions over the next 6 months. It's just kind of like, as you extend that out, the better and better the trend following statistics become.
Right. And plus, we've been in a 15-year bull market during that period as well.
Yeah, it's true. But in fairness to that, it hasn't really mattered that much. If you go back and look, I mean, at almost any rolling 10 or 20-year period, you're going to see that's, essentially those statistics stay relatively stable, which that really does play into the buy and hold. I mean, obviously, we are not just buy and holders because there's a lot of other stuff that's happening. But within that, as you start to extend out your duration, you essentially just look at the same stats as a buy and hold investor.
Sometimes you have these very long bear markets, like you had in the 2000s, where the stock market was negative. I guess if the 60% rule holds during those periods, does that just mean that the drawdowns are just more severe?
Yeah, without question, right? So if you look at the totality of the drawdowns versus the upside, other than right around the V bottom, you're going to see a lot more deterioration in bear markets than you will acceleration in bull markets, right? I mean, I thought one of the and this was a client that asked us to do this back, I think it was in 2011 or 12. They asked us what percentage of days were up. I'll pose it to you. What percentage of days in 2008, obviously a terrible bear market, what percentage of days were positive on the day and what percentage of days were negative on the day?
I'm guessing it's probably more than half were positive.
It was 50-50. But
Okay.
it does tell you just how much that skew is, right? So it was almost perfectly 50-50. But, and I think that's an important part of this business too, that absolutely gets overlooked. People are so, they're so focused on having a system that's right 55% of the time. They think it's blackjack. It's not blackjack. And the reason is that the asymmetry of your outcome is so much different, right? So you can tell me, in fact, we run some systems that are right about 41% of the time. And people are like, well, how can that possibly be? How can that be profitable? Because when it's right three times to the losses that we take every time it's wrong, right? So you start putting that math together and it actually starts to accelerate pretty quickly. In fact, one of my favorite systems that we use is right 19% of the time. I mean, it is psychologically and emotionally devastating because, it's not one out of every five. You'll have strings, and that's where you have to be very good on the money management part. You'll have strings where it might be, right 1 out of 10 times, right? Because it's randomly distributed or normally distributed. And so, you need to have those big wins when it hits. And that's exactly what that system does. The reason I like that system, it's much easier to employ when you have a machine telling you what to do versus, you doing it yourself. But the reason I like that system is I know if it's hard for me, and I've been doing this a long time, I know psychologically it's almost impossible for the average investor to employ that system. Right? They just won't be able to do it. And so, I think a lot of that advantage that you can find in this business is having the emotional wherewithal to be able to withstand things. Obviously, from a risk management standpoint, you have to understand that as well. But to be able to withstand some of these things that just are too emotionally taxing for the average person to employ. And I feel better because we don't see degradation of those systems because I think it's just too hard for people. And that's one of the keys to this business is finding things that are too uncomfortable for other people to be able to easily exploit.
Right, because that will keep that value persistent through time.
Yes.
So let's talk about timing a little bit. Obviously, timing markets is challenging. How crucial is timing in your analysis when you're looking to identify potential market moves? In other words, do you lose a lot of the value if you end up being too early?
Oh, without question. But that's what we do. That's so, I think, unique and helpful is we don't end up being early. From listening to the market tells us how we should be thinking about things. And there's plenty of situations where you end up with the value traps, right? That you might be getting signals from the fundamental side that say, this is a screaming buy, this is a screaming buy. It then goes on to lose another 50%. Ultimately, it might have been a buy. But I think the real question in those circumstances is, are you willing to have that 50% drawdown to know that you were right eventually, but maybe you were wrong? Or should you just wait it out and let the market tell you that value is being recognized? And we take the latter course of action. We look for, we like cheap, we like value for sure. But we only will go long value if in fact the trends are in place to tell us that value is being recognized. And a very good contemporaneous example right now is China. We got long China back in the beginning of the year and then added to it recently here this last month because the market was telling us that these things were being recognized. And so that's, that's how we think about it, which is kind of putting that. And I always think about it in terms of opportunity cost, right? If I can be in actively ascending or bullish environments and not wait around for the market to recognize what I think is a value or a good opportunity, then I'll always be keeping that money working, and that's important in the long run. That becomes very, very important to. It's just like inventory. I mean, we think about money or cash just like we do inventory, and we want to keep the highest return on that inventory that we possibly can.
It sounds like one big distinction between mean reversion and trend following is with mean reversion, you're not really looking at whether the market is going up or not in terms of what you're investing in. You just see the value and you buy. Whereas with trend following, you may see the value, but you're effectively waiting until the trend is supporting that.
Yeah, I mean that's presuming that it's going down, right? So a
Yeah.
lot of times, I think this is an underappreciated aspect of technical analysis as well. It will often uncover gems that you just didn't even think about, right? In other words, why are oil service names turning higher in unison, right? Maybe you weren't even thinking about energy, and so it gives you that focus, that gives you that alert that you should be doing more work on oil service names because something's happening where the market is recognizing these. And, maybe it proves that, they're an extraordinary value. Maybe there's a shift. Maybe it's political in nature. Who knows? I mean, it can always be almost anything. And I think that's one of the real values of technical analysis and listening to the market is it helps you uncover ideas that would have been much more difficult to come to on your own or, reading research reports or whatever the case may be. It gives you kind of a bright white light on these emerging ideas. And on the other side too, it gives you a pretty bright white light of, hey, these companies are killing it. They're doing everything we could ever ask of them, and yet they're going down. What is happening there? What are we missing, right? And so it's just a good, I think, mirror and reflection on not only where the positioning is, but how strong the thesis might be.
So let's dig into that a little bit. Would you elaborate on your approach of interpreting price signals rather than trying to construct a narrative?
Oh yeah, I mean it's been so long since we've tried to build a narrative. I don't even remember what that's about. I think narrative is one of the most dangerous words in this business. I think look, it's as old as the day is long. That people relate to stories, people relate to the narrative, and so they get comfortable with the narrative. They get comfortable with what that story is, and a lot of times that narrative just gets shaped by that comfort factor. And so we really are. I mean, look, I think narratives are interesting. I will listen to them, but I do not invest in narrative at all because I think they put blinders on you on both sides. And I think it's very, very dangerous to be too beholden to the narrative. Now, do we want to know what the narrative is? That's probably worth knowing just to kind of understand it and frankly, maybe use it against people when the time is right. But for the most part, we just don't traffic in narrative because, everybody's got a different one. And I think it becomes very, very dangerous. So we'll listen to price. We'll listen to or watch, I should say, the positioning and see if people are overly aggressive around the narrative. I mean, the AI stocks were a really good example of this back in the summer. We had a couple of our indications that just said the upside pricing was more elevated. The expectations of the upside prices was more elevated than the historical runs that they had, right? So as a trend follower, you'd say up is good, and 95% of the time we would say that is absolutely right. But we have a couple techniques that we can look at around positioning and expectations. And when the expectations are above and beyond that which we've already seen from a historical pricing standpoint, that's where we take a step back and say, that is priced to perfection. That's going to be very hard to beat. And we'll take at least the other side of it, if not just, look for a pause in some of these names. And that's played out very, very well in the third quarter with semiconductors. We're starting to see a few of them come back a little bit. But generally, that group is weaker, I think, than what people might otherwise anticipate, given that narrative that's out there.
One thing that I'm interested in is the market price obviously tells us a lot, But isn't it just telling us about the past as opposed to giving us an insight into the future?
Isn't everything doing that? I mean, the balance sheet, the income statement, everything is in the rearview mirror, right? So, I think if you unpack that, that becomes pretty fragile. As a critique against technical, it might be a critique against everything, but I think it's a pretty fragile critique. Um, the other part that I would just point to again goes back to those statistics, which is if it's up, it's likely to be up, and so that becomes that auto correlation ends up being fairly predictive. The one thing I always tell our clients, I'm like, we're not in the fortune telling business. I mean, that's not what we do. Predicting the future is hard. There's no doubt about it. Predicting the future is hard. So what we're really looking to do is just take advantage of the opportunities when they present themselves to us that, we think are aligned most bullishly. And, one of the ways to think about that is, I'm always interested when people say, well, what do you think of XYZ stock? And we know certain things that we look for that will say, okay, well, this should still be trending higher. You might have a pullback down to this level, which is X deviations, et cetera. But when we really look for our opportunities, it's what the market's giving us, not what we want to project on the market. What do I mean by that? Somebody might say, well, what do you think about NVIDIA? And I'd say, okay, well, it's okay. The trend's up and the relative performance is breaking out. That should be all right. But maybe you should be looking at this because we know that it's oversold, it's in an uptrend, it's got these characteristics that we look for. And when we go back and look, these are high probability long-term winners. Well, you didn't come to me with that name. I'm just giving you that name. And I think that's one of the things that we're very good at, which is sort of being receptive to ideas. We're not trying to force what we want to happen on the market. We're listening to what the market's giving us and trying to use that. And I think about it exactly the same way as trying to make a living in New York City, walking around looking for $100 bills on the street. Like, you might find one, and if you do, you're going to pick it up, and absolutely you should pick it up, but you're probably going to go hungry pretty quickly, right? Instead, we're just saying, look, we're not trying to force that somebody's going to drop that bill on 42nd Street. Like, it's just not how we think about it, right? So we're looking for ideas as they come to us. When we see a dollar bill, we're going to pick it up. But we're not going around saying this, somebody drop a dollar bill for us, please, for God's sakes, we need a bowl of soup. And so that's one of the things that I think is really important. And if you want to use this discipline to really make good money, you have to be willing to not say, we're going to have X percentage in semiconductors and X percentage in energy and you're just going to have to do what the market tells you is the high probability events. And, that might not be as much fun. I mean, I know that there's a certain utility, to ripping apart balance sheets and going through it and understanding what the company does and having management meetings. I get all that. We just think about it differently, in terms of finding those opportunities.
Yeah, you made a very important distinction, which is it's not about predicting the future with certainty. It's about putting the probabilities in your favor. And technical analysis is a great way to do that.
Without question. It's we are essentially trying to find the coin that is going to come up heads 2/3 of the time. That's it.
And even in the cases where it's less than half the time, if there's asymmetry in the payoff, that can be very valuable as well.
Absolutely. Yep. And those are more of our behavioral elements. We had a great example. We had a capitulation signal in China back in the end of January of this year. And we just know that there's a high probability that it's going to bounce after about 6 months. We frankly have no idea. Sometimes it continues, sometimes it doesn't. We just got the reaffirmation of that, which was nice and supportive. But what we really know is that the downside versus upside is absolutely skewed positively, right? So even if it's just a 50-50 bet, which in this case is actually better than that, but even if it's just a 50-50 or less, we know that the upside is substantially different than the downside. Now, the hard part, and this is where narrative is important, the hard part is nobody is thinking about owning those names at that point in time. That's one of the reasons why you have capitulation, right? So the narrative is it's uninvestable. I can't invest in Chinese communism. I can't, blah, 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 sanctions, et cetera. You have to be able to put that aside. It's not easy to do, but we've just got enough iterations of this that we've seen it time and time again. And I think that's an important part of one of the things that we do when we go back and look at these things. We pull the news sources, right? We pull what was the New York Times saying about this, the week before and the week after? What was the Wall Street Journal saying about this around the point of the lows? And we do that because we want to construct what was happening. So when we talk to clients, they can see this was not, some guru out there saying buy it. This was not the data was getting better. This is not fundamentally based. This is a behavioral nuance that we recognized and is likely to move in our favor. But with that, you have to have the intestinal fortitude to be able to stand against the crowd, and that's challenging. There's no doubt about it. So, we've put our hands over our ears enough times that it's easier. It's easier for us to do it, and we've kind of become tone deaf to those concerns. But it's certainly behaviorally, mentally a challenge.
Are there other behavioral aspects that you found to be persistent through time that don't generally get discounted by markets?
Well, overconfidence is one, right? I think that illusion of control, people believe they're better at predicting the future than they really are. And so the overconfidence is one that we find a lot, particularly with indicators. And there's a lot of time spent on, Wall Street digesting earnings estimates, a ton of time. And if you look at the return per unit of time invested in that, it's not very good. So, what we really try to focus on are where do we get the most bang for our buck, if you will, in terms of return on invested time, and look for those. So we see a lot of that. We see it in some of the economic figures. We see it in some of the fundamental data that people are really, really focused on. And maybe that focus has taken the edge away. Maybe it worked 40 years ago. And as you pointed out earlier, with technology, it's, kind of become too easy to do, and it gets arbitraged away. That might be part of it. I don't know. But we have ways that we measure that through time to see if these indications are still holding up, if they're getting better, if they're getting worse, and how we should think about it.
You've emphasized the importance of credit markets. Would you expand on that?
Credit just makes the world go round, and the availability of credit makes the world go round. And there are a lot of different ways that you can look at that. I think one, we were just talking about kind of overemphasized indicators. M2 is a highly overemphasized indicator in terms of its actual predictive power on markets. There are some ways that we look at the balance sheets and some other things that are certainly helpful, but even those are supportive. What we call conditional factors. The conditions are supportive of a bull market or maybe a bear market, depending on where they are. But credit for us in the availability of credit, and by the way, that's always changing. And so that's kind of one of the fun aspects of this business where, 15 years ago, hardly anybody knew what a credit basis swap was. And I'm sure that's still a pretty esoteric term. But it essentially showed us what the stress in the system, the foreign lending markets were to dollar funding, right? In other words, I need dollars because my loans are being paid in dollars and I'm not getting access to dollars. And that was a big problem back in the great financial crisis. And lo and behold, the Fed waved their magic wand and created these direct swap facilities with the ECB and others that needed them. So we had to figure that one out, right? So we could see this stress building, and then all of a sudden that stress went away. And we're like, oh, well, how did that happen? And then we saw these new facilities that the Fed put in place. So that's always changing, right? You've got the reverse repo agreements now that are in place. So the credit markets are always kind of evolving to try to bypass, if you will, maybe the cardiac arrest that's happening in the markets, and they're looking for different ways to be able to get around that. So we measure the price, we measure the availability, we measure all those things, and we have about 35 different indicators that we look at on a daily basis, just to see where the stresses might be percolating. And right now, actually, and I think it's one of the things that the bears missed in this 2022-23 transition as we started to move higher. I mean, our work got bullish in the fall of 22, and then we got trend confirmations in January of 23, so pretty quickly, and we've been riding it really ever since then. And there was a lot of concern about the yield curve. There was a lot of concern about all these other things that had been, predictive factors historically. But I think there were a few things that were missing from that. And one of them was just the relentless improvement that we're seeing in credit. And, if you're going into a recession, credit is going to be at the forefront of showing the stress in that system. It just wasn't. So, again, that was something that the narrative was built around, that wasn't being corroborated by the markets. And that, for us, provided an opportunity to be substantially more bullish than the crowd, because, again, we were listening versus, trying to tell the market what it needed to do.
And that's a perfect example, because I remember very clearly the beginning of 23 that nearly every economist was predicting a recession because they look at the interest rate hikes that were the fastest pace in 40 years, the inverted yield curve. All these things are very predictive of a recession. So everybody was expecting a recession. And what you're saying is, by just looking at what the market is telling you, you saw almost the opposite of that.
Yeah, absolutely. And it's not always going to be right. I mean, that one really stands out because your point being there was a predominant narrative around that, right? That was really infectious in the street. And, we were kind of looking at each other saying, well, why, if that's the case, why is this happening? Why is that? Maybe that's not the case. Maybe this consensus has it wrong and the market is telling us that. Or, maybe whatever the recession was really had played itself out and discounted in the middle of 22. And now things are incrementally just going to get better. And that's what we find. And I think that's an important point, which is there's a lot of interest in recessions in our business. Recessions don't do you much good in terms of making money, because by the time the recession is called, the market is usually troughing out, bottoming out, and actually potentially going higher by then. Certainly, it's not recession, then bear market. It's bear market, then recession, then bull market, then 6 months later they say the recession has ended. But if you're waiting for that, you're gonna have below average returns almost guaranteed. The market is this discounting mechanism that is anticipating all those things taking place and really reacting at the margin. There's a saying, I wish I coined it. I didn't. I don't know who did, but there's a saying which is the market cares about better or worse than good or bad. And that is 100% true. So we saw this a lot with inflation. Inflation is 6 down from 9, but it's still high. Like, market doesn't care. Market cares that it's down from 6 and it's probably going to go to 4. And 4 is still high, but it doesn't care. The market cares about the trajectory, the rate of change, better versus bad. And that ends up being, I think a really important lesson in this business, that it's really about the first or second derivative, not the level.
And is your sense that's the case because the market is discounting the future and it has some expectations, which is basically what the consensus view is. And what really matters is how the future transpires relative to what that base case is.
Yeah, so you're getting into the 3-dimensional chess, right? So if and I know that Apple's going to grow 25% over the next 2 years, right? Well, 25% is not going to do it, right? That's already priced in. So it's going to have to be substantially better than that, or showing a trajectory to be better than that. Now, maybe if people aren't positioned for that yet, there's still an opportunity. But if that's very well discounted and in the marketplace, then, they come out with 26% or 27%, probably doesn't matter, right? It probably isn't good enough because it's fully saturated. There, everybody, or quote unquote close to everybody, who wanted to have a position in Apple will be there. And we saw some of that with NVIDIA this summer. I mean, that was no doubt in the spring and the summer. That expectation game was just so high that it was almost going to be impossible for NVIDIA to put up, in the short term, the kind of numbers that was going to allow the stock to do substantially better than what those expectations were. And I think the other part of this, keep in mind that historically speaking, news tends to be pretty equally distributed, right? So if you've got this confluence of just great news that's kind of just fallen upon the market or the security, the opportunity for just a mediocre or maybe a little bit of an outlier bad news can have a tremendous impact, right? Where if it's not extended, if it's just kind of humming along and the news has been equally distributed, that news might not have made any difference whatsoever. But if people are positioned for this just, constant onslaught of great news that they've had, and you get this kind of mediocre data, all of a sudden that has an outsized impact. So that 3D chess is not only is it important to understand what the expectations are, but are people positioned for those expectations? Because that has an awful lot to do with the profit potential or loss potential of that security.
And I feel like this is one of the main reasons why it's so difficult to predict the future. Because not only do you have to guess what's going to happen, but your view has to be different from the consensus, and it has to be correct.
Correct. Yep. That's exactly right.
So what would you consider the main limitations of technical analysis?
Well, it's a faith-based system, right? I mean, everything is, if you really kind of think about it, you have faith in, I think management's going to execute. And I think, all those end up being faith-based. They might not be as explicitly faith-based, but, if we say, hey, this looks like a great opportunity, and here are the reasons why based on this analysis, a lot of people don't want to or can't invest from their own internal constituency in a sort of non-narrative type of way, right? So I think that's something that you have to overcome. And look, I think 95% of our clients are fundamental investors. They rely on us because they know that we're very good at detaching ourselves from whatever that narrative is and just providing that kind of pure stream of consciousness, if you will, of what the market is telling us. So when they get that and then they can attach a narrative to it, they love it, right? That's exactly what they want to see. And, knowing that the market's telling us something that they think from a narrative perspective actually makes a ton of sense. So it's that disconnect of believing that $100 bill that's lying on the street is actually a $100 bill. Like, you have to believe it every single time and you have to go down and pick it up. So.
And how do you address the potential for widely known technical indicators potentially losing effectiveness over time as it becomes more broadly understood that that's an indicator?
Yeah, I think all these indicators, and we're talking about earnings estimates, so let's throw fundamentals in there too, right? So let's look, price to book has been a disaster for the last 30 years. And earnings expectations has been pretty poor for the last, call it 15 years. There have been fits and starts. You can see a lot of this on Bloomberg. It'll tell you kind of what's got the hot hand. So one of the things that we do is we always look at a rolling T-stat of the efficacy of the indicator to the forward returns, and so we can see what's actually improving, what's getting better, and what's getting worse. Now, if that goes from over a period of time +2 to -2, and in the middle the T-stat 0, then what's the point? Like, that it's just not reliable enough to work. If it ebbs and flows between significance but is getting better, then we'll start to use it. And that does happen. You can get trend following techniques that are improving, or the sensitivity starts to go down or up. And you can get mean reversion techniques that do the same. Now, one of the ways that we do that is we measure it through time to understand. So instead of just using something static, we'll use what we call dynamic moving averages. So we understand kind of what the sensitivity of the marketplace is, and we'll adjust the moving averages for that sensitivity. And what that allows us to do is kind of capture the big waves and then adjust. This is slowly happening. It doesn't happen on a day-to-day, hour-to-hour basis. But then as the markets become maybe more volatile, then it allows us to readjust for those so that we're capturing that volatility as well, right? So I think for everything, you should be doing that to know that, hey, if I went back and looked and said, free cash flow to enterprise value is the bomb. That's it. That's like, you don't need to use anything else. And I just happened to pick the point in time where that had worked over the last 20 years, and then suddenly it didn't work going forward. That's just a mistake on my part for, kind of buying into something and hoping I stay in business for the next 20 years where it didn't work, right? And didn't do any good. By measuring that through time, you can see that degradation. In fact, the Fed was the original generator of, or should say probably the biggest marketer of the earnings yield for equities versus the 10-year yield, right? Back in the early 1980s. And that had worked great for the last 30 years, whatever the data was that they published it. And going from that point forward, it was systemically wrong. And it really hasn't worked as well from that point. So, that's a very easy, not just for technical analysis, that's for all the indicators. That's a very easy trap to fall into. And so we make sure that we're looking at this through a dynamic process that at least if we don't adjust for it, it at least measures the efficacy. And we can, as we see it degrade, we can start to say, hey, this is less effective. In fact, we did this for the yield curve. And when I got in the business in the early 1990s, 1990, the yield curve was kind of the end all be all. Like that was it. And if you looked at it, the T-stat was extraordinarily good. You almost didn't need anything else. And by using that rolling T-stat that we talk about, you can see that that has degraded to the point of actually practically worthlessness over the last 10 years. It's really started with the great financial crisis when they, pegged yields. But if you looked at that, you would not have made the kind of, I think, emphatic statements that people did around the yield curve because you could just see that the deterioration of its efficacy was just blatantly obvious.
Yeah, I think it's a really important insight because what I've learned by talking to great investors who've been in the market for a very long time is one of the keys to long-term success is being adaptable. And you can't have a dogmatic approach to investing because the market learns and improves with time. And what you just described is you have some indicator that's worked for a long period of time. Once that becomes more widely appreciated, then you really have to pay attention to almost the trend of that, metric working. And when that trend starts to turn negative, then you don't use it very much because its predictive value has significantly degraded.
Yeah, that's absolutely right. And look, there are just like a basketball player. There are indicators that will have hot hands and then and cold hands. And look, if it's over a long enough period of time, that hot hand might be worth incorporating or at least having some input into your models. But without knowing where those are, I think in just kind of hope and guessing, that's a recipe for disappointment.
It may be helpful to provide a few examples. If we go back and look at stock market history, what were some extreme periods for some of your key indicators?
Well, clearly COVID, right? And I will say, if I were to raise my hand and say, hey, where are you not going to be as strong as what you would like? The within the elements of a crash, it's very hard, right? And I think that really is as lucky as it is good. So most of our indicators in 1987, there were a few that were, hey, some caution, but not this is going to be a crash caution. I mean, you probably had 15 of those, kind of similar events that didn't result in the crash. So you have to always think about it that way. So, if you're going to say, hey, we're going to have a crash, I'm going to say, okay, I don't know if that we're going to be great at that, right? That's going to be tougher, particularly if it's an exogenous event. We were good, and I would say a lot of our kind of reputation was built around the great financial crisis. We saw that with a lot of foresight. In fact, we saw it with so much foresight that it was getting to the point where I was getting kind of tired of being bearish. And even though the market was going our way, it was just like, it was such a slow rolling train wreck that, when you come in and day out, it was taking a long, I mean, we saw it. I mean, just to give you some sense here, we started seeing it in the credit markets and the swap markets in particular in the late spring of 2007. That then translated into the Bear Stearns, which had a hedge fund that blew up. It was part of a mortgage book. So that's kind of the first indication that there was that problem. And then it just kept kind of slowly seeping its way in. And we saw it in the banks first with the big top formations. And then as we got into 2008, we saw it with obviously the deterioration in some of these more industrial names that you wouldn't have expected to be a problem. GE is a great example. AIG is a good example, obviously not an industrial, that you wouldn't expect to be a problem to, kind of the housing market and what was going on. Again, remember the narrative at the time, right? It was mostly housing related. But we start seeing these big top formations and bad charts in what later became obvious that it was the financing arms of these corporations that was then causing the problem for those corporations, right? And to create an existential threat, right? Which at that point you would never have thought that that would be the case for some of these big bellwethers, if you will. So that was a long term. We saw it coming in the credit markets. We saw it coming in trends. We saw it just kind of slowly evolving, and then in 2009, we saw kind of the extreme oversold condition, and again, one of those capitulation signals, and then what we call this momentum surge, this acceleration wall, very similar to what we're seeing in China today, by the way. So that was, that was very important to us, and we rode that for an extended period of time, for years. COVID was just kind of out of the blue and disastrous. And a friend of mine has a great saying which says, if you're going to panic early, which is, absolutely true at that point in time. We had some positions on that were extraordinarily helpful, but it wasn't, I don't feel like we were high-fiving each other about that call. We were at the bottom. We absolutely saw the other indications that said, hey, that wasn't, that was a disaster, but this is not going to be a disaster going forward. We had a very strong call, looking for the market to double out of that at the time. So that worked out great. So I'm, the crash type of stuff is really, really tricky, particularly when it's exogenous like that. It just doesn't, kind of line up. Or if it does, it would have lined up 50 other times that didn't crash. So how should you really think about that? And I think that's an important philosophical thing that we think about, which is there are two types of errors in this business. There are errors of omission and there are errors of commission. I'll explain each one. Errors of commission are the ones that everybody talks about, right? I bought NVIDIA went down. I made a mistake. I sold NVIDIA. Okay, fine. That's an error of commission. I acted on it and it didn't work out. But should you also take into consideration or account the error of omission, which is you saw NVIDIA in 2015 and you didn't buy it and it did what it did, right? So even though that didn't maybe directly impact your portfolio because it didn't feel like a loss because you didn't have one, it was certainly a lost opportunity. And so, when we look at things, we actually look at things both from an error of omission standpoint and an error of commission standpoint, because I think if you blend those two and you start looking and saying, hey, I had a bite at the apple of NVIDIA and I took it, well, that's going to go a long ways to helping to nullify some of those small errors of commission that you might actually employ or have. So that for us is super, super important and gets back to, you're not going to find us talking about crashes much. We'll talk about bear markets for sure, but to say, hey, we think this is going to, that those are sensational for headlines. And the reason that we don't is, one, they're very hard to predict. And two, if we were really being intellectually honest, we wouldn't call it a victory to say we got that one right and we missed 100 others before that because it didn't happen. I mean, that to us is just as painful, if not more, than getting it right. So that's how we think about it in kind of full intellectual honesty of how we want to manage this process.
When I look back at the crashes we've experienced the last several decades, I agree. Calling the crash is difficult. Is your sense that calling the rebound is a lot easier? Because what I've noticed is you have complete capitulation at the bottom, and you have the government stepping in, providing massive stimulus. And I think if you put those two together, it seems like those are the points where you tend to get the recovery. We just saw recently with China. And you can see it being persistent, at least conceptually, because there's just so much pessimism and the outlook is so bad. And behaviorally, it's really hard to buy at that point, that it seems like that type of indicator may be more persistent through time.
Well, yes, I would say recently, but keep in mind that's kind of a new phenomena, right? The Greenspan put, that has not been, certainly it's not ubiquitous globally. It's become a little bit more so, but not entirely. And I think for good reason. I mean, you don't want the government to pick winners and losers necessarily. And so, backstopping. And look, they tried to do it. They tried to do it in around the 20th of November, 2008 with the first TARP program and inject liquidity into the balance sheet of banks. It didn't prove to be big enough, right? And then they did it again in early March of 2009. Nobody was talking about it, but that did help to spark the equity market rally. And part of that was because people thought it was inefficient, right? It just wasn't going to really work. The problem was too big, is what the expectations were. I think that's the environment that you want, where I like to hear that the government's out of bullets, the central bank's out of bullets, the authorities are out of bullets, and they're not going to be able to save the system. That to me is good news, because that does create that concern that's out there. And then you get the Mario Draghi moments. We'll do whatever it takes, and they end up backstopping it. Now maybe they backstop it incrementally, right? Which is probably better than just, here's $1 trillion. Let's see what happens. It's kind of making sure that you're backstopping it through time. I'm sure there's some type of unintended consequences to that too. But building, allowing that confidence to come in, allowing that money to kind of find its way through and be productively used, I think is super important. So we'll see. I mean, I understand the reluctance in China right now is because people don't believe in communism. They don't trust Xi Jinping. I understand all those things, but I do see this, again, sort of putting our hands over our ears and looking at what the market is telling us today is very similar to some of these other points in time that were, pretty meaningful moves. And even if this one proves to be wrong, again, the idea is that if it's wrong by that much. And if it's right by a lot. That makes a big difference.
It's a very fair point, because what I said earlier has this assumption that the government or the Fed has significant credibility when they come in and say, okay, we're going to, not on our watch is this going to happen. We're going to do something to recover economically. They have to have the credibility for the market to react to that. And you shouldn't assume that's always the case.
Yeah, and if you think about it, right? I mean, we've seen some mission creep, if you will, right? Every time, like in the charter, they were only allowed to buy public debt, right? Now it's private debt. Now it's not even limited to investment grade debt, right? At what point does that start to flow into equity ETFs, right? So as that mission creep gets larger and larger, I think the concerns as kind of the free market become higher and higher, right? That you can't just save the system for itself, but it has to be done in a way that it's going to reallocate capital in the most efficient ways, and that means some people are going to go to zero, right? But that is going to clear the way for the others who have been, more prudent and stronger, and in a maybe less reckless way, gives them the opportunity to step in and reap those rewards.
So how do you incorporate political and policy uncertainties that we just talked about into your analysis?
Yeah, it's a really good question. The first thing I would say is they're almost always overblown. There's a lot more emotion to them than there is reality in terms of whatever the rhetoric may be. It just doesn't, I think that's part of the beauty of our system, which is divided government. And what you really want is kind of gridlock, where neither one of them can screw it up too bad, to be blunt. We actually have an indicator that we use called the Policy Uncertainty Index. And what you would normally expect is the higher the policy uncertainty, the worse it must be for the equity markets. And it's actually just the opposite. Statistically meaningful that the higher the policy uncertainty, the better it is for equities, because the equity markets kind of understand that there's not, really much to it in terms of there's uncertainty, but it's not going to derail anything. So if anything, we use policy uncertainty hopefully to our advantage and contrary to what most would think, which is the higher the uncertainty, the more bullish that is, particularly on certain aspects of the market. And I think you're seeing part of that right now, less than a month before the election, and you can see that volatility, the equity market volatility is relatively high, particularly as it's measured against the fixed income spreads or credit concerns. And when we look at that through time, we see that when that spread is high, and we have to do some mathematical transformation there, but when we see that when that spread is high, historically, that's very good for equity markets out the next quarter. And so, I think you're seeing part of that with the election right now is that equity markets are uncertain. They tend to be a little bit more emotional around these things. The credit markets are just, am I going to get paid back or not? Right? That's all they really care about. And so, they're much more stoic about it. And as that spread rises, it actually tends to be bullish for stocks because that premium that's in the equity risk of volatility starts to go down after the election, regardless of who wins, right? So to us, that's an opportunity as we see it for the markets, at least in the very near term. It also plays into how we think about the political ramifications. More times than not, when you look at seasonality in presidential years, the market bottoms about 3 weeks prior to the presidential election. So a few things there. One, again, the election ramifications are hardly ever a problem. Two, the market has it figured out pretty efficiently weeks before the actual election. That wasn't the case in 2016. That was probably the biggest outlier, but that actually proved to be bullish, not bearish. But all the other ones are pretty good. The downside skew is very, very tiny around elections. So we saw it at Merrill. We've seen it all the time, particularly on the retail side. I'm not going to do anything until after the election, and that actually ends up being a mistake historically.
Which market participants do you monitor most closely? The Fed, institutions, retail investors, or others?
I don't listen to Fed speak. That's what Neil does for us. We look at the numbers. We look at the balance sheet. We look at those inputs. We look at positioning from ETF flows. We look at positioning from the futures market. We look at positioning in the options market. But we don't break that out between institutions or retail. We just kind of want to know overall sentiment. So for us, it's not about who's on what side of the boat. It really ends up being about, is everybody on the same side of the boat? And if everybody's on the same side of the boat, then we'll fish from the other side. So I don't, and honestly, we have the data that shows that sometimes the institutions or the commercials, the informed investors, are actually the worst investors, and sometimes the small investor, who people kind of pick on as dumb money, actually ends up being the best investors. So we look at that data, we understand who's who, where, and when, but we find historically it's best that everybody's thinking consistently, and then you use that as the opportunity to take the other side and be a contrarian.
What would you say is the significance of market regimes and identifying them and potentially anticipating major market shifts?
Yeah, that's a good one. I mean, for us, a market regime is an uptrend, right? So within our trend model, if the trends are positive, things act differently in uptrends than they do downtrends. From there, well, what tends to drive that uptrend or downtrend? And we'll use our market cycle clock to identify the regime or one input to that regime. We'll use sentiment to know where we are within the context of that cycle or that trend, right? So in other words, at the beginning of a trend, you're going to have a lot of skepticism. At the end of the trend, you're going to have a lot of enthusiasm. And so we'll measure that through time. The Fed is the Fed in an easing cycle, in a tightening cycle, how frequently and how aggressive. That's an important regime. I think people use valuation as a regime. We haven't found it to be terribly useful. Valuation is, I would say, useful at the extremes. And so you're talking about maybe 15% of the time. But there's a lot of energy spent on, people getting into fistfights over 20 times versus 17 times, whatever. And like, that doesn't matter. It just doesn't matter. There's a lot more things that are more important than that. So we think about the kind of holistically in these big picture environments, but we're always picking around the regimes. There's no doubt. I mean, when we're doing research, we're always looking for, is there a big picture kind of regime cycle that will help us to redefine or further define some of these other regimes that are in place? There's no doubt about it. That's fun, interesting, and pretty rewarding work when we come up with it.
So one question related to that is, one thing that we've seen happen recently is inflation all of a sudden has become a concern, and it hadn't really been a concern for 40 years. And we had this inflation spike, and the Fed's reaction function changed. Has that affected your approach?
No, because things actually acted very consistently with what we would have expected. Again, that's part of our market cycle clock framework. And, I would say that according to that, the Fed should have been hiking rates in the middle of 2021. And Obviously they didn't. They waited way too long in our respects for that. So to see that was kind of out of control for longer than what they wanted wasn't a huge surprise for us or to us. At the same time, they've been very aggressive at tamping that down. Um, and so I think that's putting things back in a normalized phase. We haven't changed anything because it actually reacted very similarly to what the previous constructs were. So no, I mean, if anything, it was more affirmation for our work as we've used it because it kind of held up from an out of sample set, if you will. So again, that better or worse on the inflation side, better or worse on the growth side, really fell in line. And our market cycle clock moved bullishly into the bullish zone back in November of 22. So almost exactly 2 years ago now. And, at the time that was absolutely 100% contrarian. And then we got the trend confirmation in January. So yeah, no, that actually held up very, very well for an out of sample set.
Are any of your primary technical indicators signaling notable trends or patterns in the current market environment?
The China call is probably our biggest one right here, just because that is just so kind of, stars aligning, if you will. I would say I think the tops that we're seeing in global yields is more pervasive and probably more telling than what the consensus is. In other words, it looks like we have a top in 10-year U.S. yields, but that's also happening in gilts. It's also happening in bunds and oats and the like, in Europe. So I think there's more of, probably a stabilization to lower rates on the long end of the curve than what the consensus is expecting. But from that point, we're 2 years into a bull market, and things are kind of humming along as we'd expect. I would say the credit markets have held up better than even we would have imagined on the corporate side. That's probably the one outlier that I'm like, wow, that was much, much better than even I would have expected. Had you asked me to predict the future, we would have likely gotten that one wrong.
One topic that has come up recently is the market concentration. For example, the US as a percentage of global market cap, and also the dominance of the Magnificent Seven stocks. How do you think about those?
Yeah, we don't. It kind of is what it is. We look at equal weight and we look at cap weight. There's a distinction, but it's not like equal weight's going down at the expense of cap weight. It just hasn't kept up, but that's not that unusual. Breadth has been okay. I get that it's frustrating if you're a portfolio manager with individual securities and, you have to have a kind of a concentration effect there. But, we don't view it holistically as, again, an existential threat or problem to markets. You just kind of have to play along. I mean, the idea is that they're dominant companies, right? And they're growing, and they're still an uptrend. So as long as that's the case, we'll stay with them. I think what you end up with, and you can see this through time with Home Depot, even Apple, and some of these other just historically strong growth companies, is they'll have these advances. They'll go into these 18-month consolidations. The drawdowns in those consolidations will be as much as a third. I mean, they're not comfortable to be in, but they end up being just these big consolidations that then break out and go on another run. And I think that's probably what we're looking at with these names for an extended period of time. If they fail, if they change trend, then we'll definitely start to pare back on some of those. But until they really show their colors to us, we continue to believe that the trends are persistent there.
The last question I'm going to ask you today, Jeff, is: are there other major market risks that you're currently monitoring?
Well, I think there's two, and this gets back to credit liquidity. The first one is what happens when the Japanese central bank, the BOJ, Bank of Japan, starts to normalize their curve and terminate this quantitative easing. And I say it because it's been going on for so long that I don't think anybody really has a good handle on how much global liquidity has been provided by the BOJ. And so if they're changing that, I just want to be very, very aware that this is something that's so big that it, is happening right under our noses without us even really, fully appreciating what what kind of impact it might have. So that's important. I think that will continue to be important. I think that's a big risk that we call them lottery ticket risks, right? It's a very, very low probability of it having an impact, but if it does, it could be very large. So we want to think about it that way. And then the other is the Fed, right? The Fed is embarking on this quantitative tightening program as they're lowering rates, right? And they're trying to reduce the size of the balance sheet. They're trying to get rid of some of these facilities. So again, the plumbing, they're fixing the plumbing or reconfiguring the plumbing as all the bathrooms in the house are still active and working, right? So we'll see. I mean, I'm not sure how that plays out. Hopefully they've got a good handle on it. We don't see anything yet, so I don't want this to sound like we're hitting the panic button on anything. But those are, I think, two big risks that are relatively complicated, but in essence are fairly simple, which is liquidity up or liquidity down. And obviously that can have a huge impact on asset pricing, asset volatility, et cetera. So those are two things that are definitely worth monitoring as we go forward.
Well, Jeff, this has been great. I appreciate you sharing your insights, and I know our audience did as well.
Thank you for your time. I appreciate you having us.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed.